What if I told you that one historically bad day for the stock market not only led to the Great Depression, but also the Second World War? That's how incredibly impactful the stock market crash of 1929 was to not only Americans, but also to the world as a whole. But how did we ever get to the point where the stock market controlled so much of the economy? And how did things go bad in such a hurry? That's what we are going to be covering today as we poke around that faithful few days in an effort to figure out just exactly what went so wrong. Make sure to stick around for the whole video too, as you're not going to want to miss out on all the ways that this awful day led directly to the America that we now know today. Chapter 1: How the American Dream Turned People into Fools. The 1920s were largely considered to be an era of excess and new money. People that grew up wealthy were now having to share their hobbies and events with people that just got lucky investing in stocks. The stock market seemed magical to people at the time, with many Americans blindly investing and many of them still getting rewarded for it. The idea of getting rich overnight wasn't some kind of dream anymore, but a reality that your neighbor or coworker might actually achieve. Because of this, money was being thrown around like never before, and the era was affectionately coined the Roaring Twenties as a result. As share prices rose to unprecedented levels, an economist at the time named Irving Fisher said, "Stock markets have reached what looks like a permanent plateau." Americans were ignoring bigger issues underneath the surface, however, and it was going to hurt them in just a few years. Production of goods had been going down as Americans desired to become investors rather than work in the same businesses their stocks were a part of. Farming was also starting to become affected by droughts and natural disasters, something that would make the fall all that more hard on Americans. Everyone had convinced themselves that this age of spending was here to stay, and the confidence in the New York stock market was higher than maybe ever before. The United States banks were also issuing out loans just for the purpose of investing in stocks, and this would play a big part in the crash that was just about to hit. By the year 1929, America had already seen a dip in the economy, but almost everyone waved it away as being nothing more than a blip. The production that the U.S. was putting out was lesser than usual, and unemployment was starting to rise. Still, the prices listed in the stock market remained strong, and so nobody realized how inflated they had now become. That leads us all the way up to October of that same year, where America would change forever, and the world would feel the waves of this monumental crash. Chapter 2: The Crash and its Immediate Aftermath. The date is October 18, 1929, and the stock prices continue to fall. Throughout the last couple months leading up to this date, the stock prices had begun to stagnate. But the hope was at the time that the market would bounce back. After the latest dip, however, Americans would begin to grow nervous, selling their stocks and attempting to distance themselves from what was coming. 6 days later, on a day later known as Black Thursday, almost 13 million shares were traded, a record number. Investment companies and well-off bankers would try and stabilize the market by buying up large chunks though, which resulted in a decent rally the next day. Everyone hoped that the storm was over, and that their efforts to rebalance the market would buy them time to calm down the public. That following Monday, however, more people traded in their stocks, and the market went into freefall territory. The next day, Black Tuesday would strike, and over 16 million people would sell. Stock prices continued to fall at an alarming rate, which did nothing to help ease the public's worries. The crash was in full effect now, and billions were lost, wiping out thousands of investors and directly causing the depression that was about to come. So many people were trading in their stocks that the stock tickers actually had a hard time keeping up, and even the machinery could not handle the sheer amount of trading that was taking place. The fallout to this day is where the real story is. But before we get to it, please leave a like if you're enjoying the video so far. Also consider subscribing to our channel if you want to see more videos like this one. Chapter 3: The Fallout. The fallout to the 1929 crash was as swift as it was brutal. The market was literally bottomed out, and there was nowhere to go but up. Seemingly in an instant, the hopes and dreams of an entire population were completely wiped out along with their stocks, and families tried their best to rally and pick up the pieces. The problem here is that the stock market was masking a teetering economy as it was, and it felt like people were only now starting to notice them. For one, the agricultural sector in the United States had been struggling for the past couple of years, and the inflation of prices was held down because of the market's strength. Now that the market had been blown up, food was harder to come by than ever. Farmers were forced to literally let their crops rot in the fields because there was no one that was able to pay them for their labor. At the same time, soup kitchens and other local programs began popping up across the nation, and lines of people would wait outside just to get a meal. This was a long ways away from the decade of free spending and wealth that had just passed, and it created a lot of tension around the country. The market would bounce back quickly, but it wouldn't rise to the heights that it was at. By the summer of 1932, only a little under 3 years from the crash, stocks were still only worth about 20% of their value from before the crash. The Dow Jones in 1932 closed at 41.22, the lowest the value had ever been in the 20th century, and 89% below its peak. While the stock market crash of 1929 wasn't the only reason that the Great Depression would cripple the United States for years to come, it is the reason that Americans became scared to invest for years to come, and why they trusted government programs so little. But how exactly did the crash hurt the banks? Chapter 4: Setting up an era of doubt and distrust. Americans believed that they had been tricked by the government and the stock market investors in New York. They thought that they were investing money to become rich and financially stable, only to go bankrupt after trying to pull their money out. The way that things ended was really awful for Americans, who would end up in a feud against their own banks. These banks that had been issuing out loans with money they didn't even have were now coming to collect, and weren't afraid to take away anything in order to liquidate assets. Homes and cars, literal symbols of the American dream and a big reason for the surging markets in the first place, were yanked away without a second thought, and suddenly the average American had a new enemy. Citizens began to pull out their money from banks, believing that it was safer to just hide it in a safe at home or underneath their mattresses. Americans no longer wanted anything to do with these banks, which obviously caused quite a bit of strain for them. They had been issuing these loans with money that didn't even exist because they were so trusting of the stock market. Without it to prop them up, many of them went under, and those that didn't had to endure huge cutbacks and mass firings to do so. All efforts to get things back under control had failed, and the country was more hurt than ever. It wouldn't be until FDR took office that any sort of progress would be made, and the president himself had to do nightly radio broadcasts just to calm down the citizens. While this would work within the nation, internationally it was a whole different story. Because all of the world was united within the gold standard, other countries felt America's pain too. Those in Europe were put under significant strain financially, and this would lead to a lot of hardship in the region. Things got so bad, in fact, that many historians believe the Great Depression indirectly led to the events of World War II, since Germans were eager to embrace change and better their situation. And that's about all for today's video. Do you think that the stock market crash of 1929 was the biggest factor leading to the Great Depression? Or do you think it had more to do with Americans buying into a fantasy and ignoring the country's greater issues? Let us know in the comments section below. We really want to hear what you guys think. If you enjoyed the video, which we really hope you did, please leave a like as it helps us out a great deal. Also subscribe to our channel for more videos like this one.